We begin our discussion today about Business Foundations, A Changing World, Chapter 14, which is called Financing the Enterprise as far as the section is concerned, but it's called Accounting and Financial Statements. It's a pretty hefty chapter, but there's a lot of information here that's very important for a business to be able to have these foundational principles in operating. Now, we're going to go back one slide to talk about the accounting equation. Accounts equal liabilities plus owner's equity. So the way we actually think about this is think about what is an asset. An asset is a firm's economic resources, those things they own. Cash, land, equipment, buildings, and other things you can touch or things you can't touch. For example, goodwill may be considered an asset. Liabilities, of course, debts that a firm owes to others. Owner's equity is basically the equity that the owner has put in. So it equals the assets minus the liabilities, reflects historical values. So the easy way to think about the accounting equation is to think about what does the formula entail. It entails your liabilities plus your owner's equity equals your assets. That's actually the accounting formula and the equation that we will begin our discussion with as we're discussing this chapter. Now, one thing that's actually a part of the overall equation is owner's equity. The owner's equity is a portion of a company's balance sheet. It contains all the money that's ever been contributed to the company. And so, for example, when I started my firm years ago, I actually put in a pretty large sum of money that was actually the starting capital. And so that was considered, in my case, owner's equity. So if you see down at the bottom of this slide, it talks about the owner's equity is a portion of this florist's balance sheet, which includes the money she's put into her company. And so that's all it is. It talks about what you put into the company and gives you an idea that that information is valuable. Now we talk about this double entry bookkeeping. This is a little bit more complicated, but basically is a system of recording and classifying business transactions that maintains the balance of the accounting equation. So there are three aspects to this: balance, classification, and breakdown. Balance is basically the way you keep your accounting equation in balance. Basically, every transaction must be recorded in two separate accounts. Classification. All business transactions are classified as either an asset, a liability, or owner's equity. And breakdown. Assets broken down into cash, inventory, and equipment. Liabilities broken down into bank loans and other debts. All those are important as you're thinking about this double entry accounting system. And so it's important that we think about that. So please continue to review that information and review it in chapter 6, actually chapter 14, page 438. So we continue to pick up the conversation about this accounting cycle. It's important that we spend a little bit of time on what this is. We have the 4-step procedure of an accounting system. Now, overall, it's about examining those documents, recording transactions in various journals, posting those transactions, and preparing the financial statements. The next piece talks about the accounting cycle in terms of what these terminologies are. Now, in starting a business or just understanding business as a whole, there's a number of terminology in accounting field that you just really need to be familiar with. Journal, a time-ordered list of transactions. So that's really what a journal is. It's a list of transactions. A ledger is an accounting book or just basically a file which keeps separate sections for each account. Trial balance is a summary of the balance of all the accounts in the general ledger. So you'll see these terminologies kind of tossed around as you're thinking about accounting and what it entails. Now let's talk about the income statement. The income statement is a very important component to a business. The income statement pretty much answers the question of what is the bottom line? What information do I need to communicate? So it's a financial report that shows an organization's profitability over a period of time. It's also included or can be considered as a P&L statement, a profit and loss statement, or even an operating statement. And so there are things that are on this statement that are not in other places or that flows to other reports. Income statement is a financial report that, of course, shows the profitability over time. But you have a section here called revenue. Revenue is the total amount of money received or promised to be received from a sale of a good or services. So these could be non-business transactions or these could be other transactions. But revenue is real important that we have solid revenues as it relates to our business to be able to place that information on our income statement or our P&L statement. Cost of goods sold is the amount of money you spend to make a product or buy a product, and then you sell it for a different price. So there are terms in accounting, as I mentioned, that are just part of the actual nomenclature of learning the field. But you have revenues, gross profit, operating income. So revenues, of course, are your sales or goods or services sold. Your gross profit is your gross income or your gross earnings. Operating income here, it talks about your operating profit or EBIT or IBIT, earnings before interest and tax, income before interest and tax. And then you have the other terminology here, which is very similar here. We just kind of talked about it, income before taxes. Net income, you'll hear this terminology a good bit. Earnings after taxes, and then profit after taxes. Income available to common stockholders. Income available to common stockholders. So this is just a terminology you'll hear in accounting that you just need to be familiar with. Now let's talk about gross income and expenses. Your gross income could be considered your profit. It's your revenues minus the cost of goods sold required to generate the revenue. And of course, income available after paying all the expenses of production. So say, for example, you're purchasing an item that cost the buyer $10, but it costs you $8 to make. So the $10 they pay and $8 it costs to make leaves you with a $2 profit. That's what a gross income or profit is. Expenses are the incurred costs in the day-to-day operation of an organization. So the $8 that it costs you to make that item is actually your expenses associated with that. And so you'll see this information quite often. So you talked about expenses, selling those expenses, for example, things such as selling, general and administrative expenses, or even including depreciation. All these items are expenses, and there's a lot more in your book that talks about why this is such an important area. So there are 3 common expense accounts shown on the income statement. So you have things such as what I just shared with you here, selling, general and administrative expenses. And then you have the second item, which is the research, development, and engineering costs. And then the third area is interest expenses. And so there's more information in your book on page 444 that you can review more in detail. Now, what is depreciation? Depreciation is very simply the process of spreading the cost out of a long-lived asset, such as a building or equipment, over a total number of accounting periods in which they are expected to be used. So, for example, if you have a computer and you've used it for 5 years, you bought it in, say, 2016, and every year you use a computer, there's a depreciation expense that's taken. So that's basically what this communicates to you, that you have an example here that you can read more about it in your book as well. But depreciation is an important aspect to business, and you certainly want to take those expenses if you can, using depreciation as a process to do so. Net income, the total profit or loss after all expenses, including your taxes, have been deducted from the revenue, also called your net earnings. Most companies present the current year's results along with, say, 2 years of income statements. Gross profits, earnings before interest and tax, and net income are all results of calculations made from the revenues and expenses account. But they're not considered actual accounts. So you have to just simply understand what net income is as it relates to these expenses in accounting. Balance sheet. The balance sheet is the second most basic financial statement, which basically shares a snapshot of the organization's financial picture at a certain time. Now, the balance sheet, of course, gets its name from this equation, which talks about assets must equal liabilities plus owner's equity. And so you'll see more information regarding that, but balance sheet is a very important. Instead, the balance sheet is basically kind of an accumulation of all the financial transactions conducted by the organization. And so you'll see more information here that talks about why this is such an important component, but the balance sheet is very important to a financial business because of what it includes on the balance sheet. So the balance sheet has things such as current assets that can be converted or used, converted into cash or used within the course of a calendar year. Things such as cash or temporary investments or even accounts receivable, those people who owe you. Accounts receivable is money owed a company by its clients or customers who have promised to pay for the product at a later date. And so that's important for you to know that those expenses and those items are listed on the balance sheet as an asset. Balance sheet liabilities. You'll have things such as current liabilities, a firm's financial obligation to short-term creditors, accounts payable, the amount a company owes to suppliers for goods and services, and those accrued expenses, an account representing all unpaid financial obligations incurred by the organization. So just keep in mind that all these things here are listed on the balance sheet. So you have your current liabilities, your accounts payable, accrued expenses, and then of course the slide before that talks about your current assets and accounts receivable. And so the last couple of slides will talk about the owner's equity and why that's also included here. It's the owner's contribution to the company, as you remember from earlier conversation points. Accounts listed as owner's equity on the balance sheet may differ from company to company. So you may have things such as corporations who sell stock to investors or those who have common and preferred stock options. So you'll have that information listed on a balance sheet. Now I will tell you, it can sometimes be difficult to understand what a balance sheet is, but on page 447, it's a pretty easy explanation of all the items that you typically would see on a balance sheet, and there are plenty of them. Now, how about a statement of cash flow? This is the third primary financial statement as it relates to a business, which explains how the company's cash has changed from the beginning of the accounting cycle to the end of the accounting cycle. And so you want to look at this because this gives you some information. So it shows how the cash account came in from one point of time. Most investors want a better picture of how cash flows into the business and out of the business. More information regarding statement of cash flows, including cash from operating activities, cash from investing opportunities and activities, and cash from financing activities. All of these different transactions help to share with an investor what has happened in the business and why the cash is going in and out. This information communicates that very efficiently and very succinctly. Now, one area of a business that I really find fascinating that is pretty challenging to really explain in a big way is ratio analysis. Ratio analysis basically are a calculation that measures an organization's financial health. And so you'll see these primarily in business analysis where you're trying to find out what's the actual information associated with what's going on with the business. And what happens, profitability ratios are there, profit margin ratios are there. All these ratios tell you something about the company. Now you'll have financial ratios. The ratio is simply one number divided by another. That's really what it is. One number divided by another, which results showing the relationship between the two numbers. So financial ratios are used to weigh and evaluate the firm's performance. It's also a good opportunity to just take a look at this and see exactly where in your business are your ratios, if you have a business, or just really trying to understand the health and strength of the organization in which you're working from. Let's take a look at profit margin. Profit margin is really important as well. Net income is divided by sales. That's how you come up with your profit margin. And here's an example here that talks about how Microsoft has a calculation associated with this information on developing ratios and what that ratio actually means. Return on assets. Net income divided by assets, which is different than the one we just talked about, which is more focused on the profits. So it's net income divided by the sales. This is return on assets. Net income divided by the assets that you have. And so this is the things that you owe. Remember what an asset is. And you have another ratio here, return on equity. Net income divided by owner's equity. Also called ROI. You may have heard of this a good bit on return on equity or return on investment. And so I really like being able to talk about this because this gives you an idea of what the company's actual health is as it relates to the success of the organization. And so all these ratios here tell you something about the organization that you wouldn't normally find in other areas. And then the reality is that ratios that measure how well a firm uses assets to generate each dollar of sales. And that's why you want to see a ratio analysis. The last thing we'll cover here is receivables. We'll talk more about that and how receivables are really important, but you can review more information about that in your book on page 455 and 456.